This is Akashvani. In the program Spotlight, now we bring you a discussion on transformation in Indian banking sector reforms and achievements. The participants are Siddharth, economic analyst, and Ishan Mittal, anchor.
Speaking at the Rozgar Mela on Friday, Prime Minister Narendra Modi hailed the revival of India's banking sector under his government. To discuss this, we have with us economic analyst Mr. Siddharth. Mr. Siddharth, welcome to the show.
Thank you.
I'd like to ask you, the PM hailed the Bankruptcy Code as a step to minimize bank losses. Could you talk about how this has worked to the banking sector's advantage?
Well, it was a landmark legislation which was introduced and piloted in 2016. And if you look at the numbers, they speak for themselves, because in these years between 2016-17, when the law kicked in, until 2022-23, in all about 6,560 cases were initiated for corporate insolvency, which has been bulk of the insolvency action that has taken place in the country. And if you look at the numbers a little more closely, you would find that the fear of insolvency action, which under the law provides for ouster of the promoters and the introduction of resolution professional, who in turn works along with a committee of creditors to look for a new resolution applicant or a successful bidder who takes over the company. The fear that the management and the promoters would be ousted by the admission of an insolvency case in the National Company Law Tribunal, that is enough of a deterrent for the promoters who do not pay either the banks, who are classified as financial creditors, or the operational creditors, who are, the vendors and the other creditors. So just the fear that they would be ousted has resulted in a large number of cases getting closed even before they are taken up for resolution. And if you look at the total number of cases which have actually yielded results, it has been quite high. 1/3 of the claims of the creditors have been resolved. And if you look at the liquidation value, it works out to about 168 or 169% of the liquidation value. So if the liquidation value was 100, banks are actually getting about 168 or 169 rupees, banks and the other creditors. So that has been a big factor which has helped banks and the other creditors realize money. And some of the very, very large companies, be it the likes of Bhushan Steel or SR Steel, JP Infratech, they have seen their promoters being ousted, and in a large number of cases, new management has taken charge. So that has been a huge plus. And that has had the desired effect in improving the credit culture in the corporate sector. There is the other fear of, because in a lot of cases, the same promoters were also guarantors. So the law also provides that, say, if you recover 40 rupees out of the 100 that is owed, the banks and the other creditors can approach courts to recover the remaining 60 from the guarantors. So the promoters then have to pay from their own side because they were also guarantors to those loans. So these are things which have really helped.
Thank you for that. Those numbers are truly speaking for themselves. Since the 2008 financial crisis, Indian banks were understood to be plagued by the twin balance sheet problem. Recently, the finance minister said that India has not only resolved that, but also come to a point where the banks have healthy balance sheets. Could you discuss these issues in detail?
All right. So if you remember, the biggest problem for public sector banks, and it has traditionally been a problem, is this problem of non-performing assets. So non-performing assets are basically loans that remain unpaid for 90 days at a stretch, and banks then have to make provisions or set aside money for a possible loss from these accounts. If you look at the latest RBI Financial Stability Report, it says that the scheduled commercial banks have seen their net non-performing asset ratio fall to a 10-year low of 3.9% at the end of March, which at one point of time had gone up to 6.1%. And so it had hit, and at the gross level, it was at 11.5%. So that has come down, and it is a huge help to the banking sector. What has also happened is that the government and the regulator, which is the Reserve Bank of India, they have insisted on banks recognizing loans and the problems to these loans wherever they have to, which means setting aside more capital for losses. And simultaneously, the government has been getting banks to improve their lending practices, has reduced or done away with the interference that was there in sanctioning of loans. and it has also provided capital to the public sector banks to ensure that their balance sheets remain healthy and they can meet the requirements of a growing economy. Simultaneously, what has also happened is that in times like the COVID crisis, the Reserve Bank of India has also been proactive in terms of allowing for restructuring and things like that, extending some regulatory forbearance on provisioning, and also insisting that banks stay adequately capitalized. So the whole regulation and supervision of these banks have also undergone a change at the RBI level, which is keeping much closer tabs on how banks are performing, and if it sees that there is any segment where the pressure is building up or where the growth is high, then it steps in, speaks to the management and tries to get it fixed. So all these factors have worked to the advantage of Indian banks whose balance sheets appear healthy at this point of time.
Speaking of the RBI, it has recently suggested a measure called expected credit loss. How is this expected to help in banking regulation and helping liquidity in these troubled times economically for the macroeconomic situation?
So what it has done is a proposed framework for provisioning by banks. And banks will have to classify these financial assets depending on multiple stages. So this is basically, these are assets that have, even for assets which have not experienced significant increase in credit risk and things like that. So basically this is, as we discussed, increased supervision that we are seeing and preparing banks to take on the possible credit risks that arise. So this is, a provisioning system which has been put in place to check impairment of credit that they may face in the years ahead or the quarters ahead. While the final guidelines will be implemented in due course, the final, recommendations, but it is seen as more tight regulation so that these losses are taken care of well in advance.
Speaking of the buoyancy of the banking sector, and as you had mentioned earlier, the banking sector not only survived the COVID crisis and the after effects of the Russian-Ukraine war, but it also survived the kind of financial tightness that led to the liquidation of several banks in the US. How have Indian banks survived the repo rate tightening despite the broader, tighter financial environment?
See, I think we need to make a distinction between our regulations and regulations in the US and other parts of the world. In our case, as we discussed, there are requirements for banks to set aside capital and provisioning and also build up of systemic risk. So in some of the cases in the US, for instance, the collapse was because of a very high level of exposure to a particular sector, and also the fact that the bank, one of the banks at least, was very closely intertwined with the same set of borrowers, and that kind of accentuated the risk for it in times of a crisis. When one sector comes under pressure and you are exposed only to that sector or largely to that sector, you're bound to feel that pressure. Here there are norms on how you have to invest and things like that, which have kind of helped our banks. And so our regulations across the sphere as robust, if not more robust than even some of the advanced countries, which has helped Indian banks. As far as the increase in interest rates is concerned, so if you look at the numbers, the whole idea was to slow down some sort of, build up of risk and slow down the economy in the wake of the rising inflationary pressures, especially coming from imported inflation. So the numbers don't bear that at the moment. Credit demand remains quite robust, and this is true across sectors, be it agriculture or personal or corporate loans. So but in the coming quarters, the expectation is that demand will moderate and that will lead to some slowness, although we are expected to remain among the fastest growing economies in the world.
Talking about India becoming and remaining the fastest growing economy in the world, given the current macroeconomic challenges, could you talk about the banking sector's contribution towards the $5 trillion broader goal set by the PM, as well as the broader motto of financial inclusion that the PM has propounded?
Well, the whole idea of having a cleanup in the banking system was to prepare it to be ready to meet the credit requirements of the economy. And what has happened in the last few years is greater formalization of the economy, which is borne out by the fact that the number of taxpayers under GST has almost doubled from the time it was introduced. Also, there are more people who are part of the formal banking system, and there have been multiple initiatives starting with the Jan Dhan campaign, where banks opened crores of bank accounts, and it has now reached about 50 crore bank accounts now, with a large sum of money in these accounts. And the people who had got these loans are now part of the formal credit system also through various initiatives like Mudra or the loan scheme for housing under PM Awas, or for that matter, even this scheme that is there for street vendors. So these are segments of population which did not have access to the banking system. Now, through schemes and initiatives, and the fact that there is greater availability of financial tools and instruments such as Aadhaar, the credit profile of these thousands and crores of account holders is now available with banks who find it easier to lend. What has also helped is the guarantee scheme that the center has been running since the COVID crisis. First, it was for MSMEs, and then it was expanded to street vendors, which provides an additional comfort to banks when it comes to lending to these segments of the population. Besides, there are new tools being tried out after UPI, which has been such a successful, initiative. A similar thing is now being tried out by RBI, which has prepared a platform of sorts where people without a credit history, but with some sort of landholding records and, government issued identity card, can get loans on the basis of their landholdings. Or if someone is selling milk to, say, Amul, it can, depending on the amount of milk she or he sells, can get access to credit from banks, which can use this platform to access data and give loans through what RBI is calling frictionless credit. So these kind of initiatives have helped the unbanked get into the banking system and is formalized credit, reduced the dependence on money lenders who were charging exorbitant rates of interest. So it's been a win-win deal for banks as well as the borrowers.
A UPI for loans truly sounds revolutionary. Going forward, I want to ask you that the S&P has forecast that Indian banks' bad loans may moderate to 3 to 3.50% by 2025. What does that kind of figure say about the banking sector's upcoming forecast, about the future of the banking sector in the coming couple of years?
Well, it suggests two things. One is that, the current initiative of cleaning up banks is going to persist, number one. And number two, the chances that the economy is doing well, so the chances of loans turning sticky or bad are reduced. So it is both an indicator of how our banks are going to perform and how our economy is going to perform. But on both counts, India seems to be doing well at the moment.
Thank you for your time, Mr. Siddharth.
Thank you.
You were listening to a discussion on transformation in Indian banking sector, reforms and achievements. The participants were Siddharth, economic analyst, and Ishan Mittal, anchor. This program was produced and presented by the News Services Division of Akashvani. You can listen to it on our mobile app News on AIR. This program is also available on our YouTube channel News on AIR Official. You may share your feedback about this program through email at airnsdtalks@gmail.com or WhatsApp on 92890 94044.